Hi, good evening, ladies and gentlemen. Welcome to Corporate Connect webinar, which is organized by SIAS and supported by SGX. Today, we are very excited to have a financial guru, Mr. David Kuo, co-founder of The Smart Investor, to do a sharing session with us. And this is followed by the company's presentation and Q&A session with the management of Yoma Strategic. So without further ado, we shall now kickstart today's program with our very first speaker, Mr. David Kuo, and he will be sharing with us on how to be a master of your portfolio. So over to you, David.
Thank you, Pauline. Right. Can everybody hear me? I hope they can. Right, I am about to share my screen and hopefully it works. There we go. I hope I'm not just talking to nobody, but here we go. My name is David Kuo, and I am from The Smart Investor. I used to be at The Motley Fool, but about a year ago, less than a year ago, we started The Smart Investor to carry on the work that we've been doing here in Singapore to help people invest smartly. And today's presentation is all about how to be a master of your portfolio. And ultimately, what I would like to start off by saying is that investing is now more important than ever before. And the reason for that is quite straightforward. We've got to take our heads out of the stands now. We've got to realize that things are happening around the world. We first of all started with the great financial crisis, and now we've got COVID-19. And what this really means is that interest rates, there was a time when we could enjoy relatively high interest rates, when we could take the cash that we had and we could put it into a savings account or buy ourselves a bunch of bonds. And that was more or less all we needed to do to ensure that our savings, the money we put aside for the day we decide to retire, would grow. But unfortunately, that is not the case anymore. What has happened now is that interest rates have been gradually eroded, gradually cut. First of all, because of low inflation, and then we had the great financial crisis, which caused central banks around the world to cut interest rates to try and get the banking sector back up to where they were prior to the great financial crisis. And now we have COVID-19, which has caused central banks to cut interest rates even further. And what we need to remember is that whilst many of us would hope that COVID-19 would one day go away and that things would be back to normal again, that doesn't seem to be the case, because what is really happening is that the number of cases is continuing to rise around the world. And it is very worrying, not just for us as consumers, but also for central banks who need to find a way out of this problem. Some people say this is a health crisis, some people say it's an economic crisis, and other people say that it is really just a crisis of confidence now. So until we start to see the number of cases of COVID-19 start to come down, the central banks have no option but to continue to cut interest rates and hope that governments will continue to find ways of pumping money into the global economy in order to get global growth going again. Now, COVID-19 has been called the virus of truth. And the reason why it's been called the virus of truth is that I think many economies, and maybe some of us, have not been very truthful about various things. Perhaps some companies have not been very truthful about the way they operate their business. And what the virus of truth has done is to unearth some of those untruths around the place. I mean, if we have a look at the number of jobs that have been lost around the world, according to the International Labour Organization, close on to 400 million jobs have been lost as a result of COVID-19. Many of us would hope that these jobs will one day return, but what if they don't return? What if these 400 million jobs are lost for good? What are we going to do then? I mean, this is a problem that governments around the world are going to have to try and find ways of resolving. So we start by saying that the central banks have stepped in, they cut interest rates, and in the case of American interest rates, the Fed fund rate has been cut close to 0.25%. Now, during the great financial crisis, many people had thought that, well, once the banks were okay, then maybe interest rates would go up. So which is why they came up with this acronym called TINA. There is no alternative. That was during the great financial crisis. They said there was no alternative, but they hoped that there would. And really what happened was that the Federal Reserve in America started to raise interest rates again, ever so gradually, because they thought the banks were much safer. And those people who at the time had to go into the stock market then came out of the stock market because they thought that they could then go into other risk-free investments such as US Treasuries, Singapore bonds, and maybe some savings accounts. But this time we have what I would call TRINA. There really is no alternative this time, because until such time that they try and work out a way in which they can solve the problem of COVID-19, there really is no alternative for us. If we leave our money in a savings account, if we just go off and buy bonds, unfortunately that money is going to lose its buying power simply because of the amount of money that has been created by central banks around the world, and also by the amount of borrowings that governments around the world have had to make in order to try and stabilize their own economy. So we are in a state of TRINA at the moment. So my solution to this problem is to build yourself a portfolio of good income paying shares. Now, some of you out there will be saying, hey, David, that's great. Go off and build yourself a portfolio of shares, but what about the volatility? What about the shares that go up and down every day? I mean, isn't that not really a solution to the problem that we have? And my counter argument is you need to be a master of your portfolio. Now, what is a master? A master is someone who is in control of something. The opposite of a master is a slave. And a slave is a person who is completely subservient to a dominating influence. So the question you need to ask yourself is, do I want to be a master or do I want to be a slave? And I think really it's not a question that we need to ask, because everybody wants to be a master. But how do you become a master? Now, in order to be a master of something, you need to know how to measure what you are doing. Now, if you want to measure the length of something, you would use a ruler. If you want to weigh yourself, you would jump on a set of scales. If you want to time something, you would use a stopwatch, an egg timer, or maybe even just a common watch. So you need to know what to measure. Now, part of the problem is that when we look at shares, we generally just look at the share price. So we buy something for $1, goes up to $1.20, a 20% gain, and we say, great, it's gone up 20%. Aren't I clever? You buy something for $1, it goes down to 80 cents, you lose 20%, and you say, oh, stupid me. Now, Albert Einstein said, not everything that counts can be counted, and not everything that can be counted counts. Now, what he really means is that share price is very convenient for you to measure how well you are doing as an investor, but it is not the right way to measure your portfolio. The reason for that is Warren Buffett once said that the fact that people will be full of greed, fear, or folly is predictable. The sequence of whether they are going to be greedy, fearful, or stupid is not predictable. So why would you want to use the share price, which is really a function of how people feel, whether they feel greedy or fearful or in some cases foolish? Why would you want to use share price to measure how well you are doing in your portfolio when these things are subject to such things as greed, fear, and folly? What I say to you is that what you instead should do is to focus on the things that you control. You can control. You can't control share prices because share prices are a function, as I said, of people's fear, greed, and folly. You cannot control share prices, but you can control the shares that you put into a portfolio. So why don't you just control the things that you can control, such as the shares that you want to put into your portfolio? Now, what I did about 2 years ago was to build a portfolio of property shares or property related shares. And what I did was I took 200,000 Singapore dollars and I bought myself 20 shares that were related to the property industry. And lo and behold, the 20 shares over the last 2 years has been paying me a gradually rising dividend. So if I measure the dividend, then I would say I have bought 20 shares that are good for my portfolio because I am measuring the output from the portfolio rather than the share price. So instead of looking at the share price and saying, what is my portfolio worth today compared to yesterday? Is it higher today than yesterday? Is it higher now than it was, say, 2 years ago? I'm not really that concerned about the value of the portfolio, but instead I look at what the portfolio is going to do for me. In other words, I'm trying to master the portfolio in order to get the portfolio to do what I want it to do, which is to pay me a rising dividend output from the portfolio. And over the last 2 years, I've collected about $14,000 worth of dividends, and the dividends have been rising over time. If I have a look at the yield on cost, in other words, what I'm earning now compared to a year ago. So what I do is I total up the dividends that I've been collecting over the last 12 months and compare that with the 200,000 that I put in 2 years ago. And what seems to be happening is that this portfolio is paying me a rising dividend yield. So I'm earning more in dividends, annual dividends now than I was previously. And also what is interesting is that this portfolio is increasing the dividends that I collect at the time when central banks are cutting their dividends. So this is the most bizarre thing. Central banks are cutting their interest rates, whereas I am collecting more dividends from my portfolio now than previously. And what I hope is that this portfolio will pay me more in dividends next year than this year, whilst central banks are cutting their interest rates. And what I did subsequently was, just to prove that it wasn't a fluke, I took 300,000 Malaysian ringgits and I bought a portfolio of 15 income-paying shares in Malaysia. And lo and behold, the same thing happened. Initially, the portfolio wasn't doing that well, but having said that, over the year, the portfolio has been paying me a rising dividend. What the value of the portfolio was worth at any point in time is kind of irrelevant to me as long as it keeps on paying me a dividend. But in the case of these two portfolios, KIP, which is related to property, and Malaysia Money Machines, which is related to shares in Malaysia, what has happened in the two portfolios is that apart from the dividends rising over the months and the years, the portfolio is actually worth more now than it was in the beginning. So something has gone right. Because the dividends are going up and because I've chosen what I hope are the right shares for the portfolio, it is not only the dividends that are increasing, but actually the value of the portfolio is increasing. And the irony of it is that from an income investor's perspective, I'm actually not that happy. I would prefer it if the portfolio was worth less now than it was previously, because as an income investor, I want to reinvest those dividends in order to generate more dividends in the future. But I can't exactly do that when the portfolio is worth more and more. So on the one hand, some people might say it's great, the portfolio is worth now than previously. But at the same time, as an income investor, I want the portfolio to be worth less so that I can buy more of those shares that I think are wonderful companies in order to generate more income in the future. So my point really is that if you want to build yourself a portfolio, the simple rule for both those portfolios, and in fact for all the portfolios that I run, is that they all look like a pyramid. They all look like what you see on the screen. It's got a layer of good, solid income-producing shares. It's got an upper layer of growth shares that also pay a dividend. And at the very top, I've got what I call some speculative or fund shares. These also pay a dividend. But what I try and make sure is that the percentage of income or strong income growing shares is greater than the number of growth shares, which is greater than the percentage of the speculative shares. And as long as I keep that portfolio looking like the pyramid, then I think I should be doing relatively well. So the key for me is to make sure I have about 60% in income shares, about 30% in growth shares, and then the 10%, which is kind of optional, I can actually put into speculative shares. So here is the takeaway. Choose about 15 or 20 good shares. And by good shares, I'm talking about good companies. 10 or 12 good, strong income players out of that bunch of shares. About 5 strong growing shares, which also pay you a dividend. And then 1 or 2 speculative shares. And if you do that, then I don't think you will go too far wrong. So this is what you do. You build your portfolio, and it's got about 15 or 20 shares. Measure the dividends that are coming out from that portfolio. Make sure that the dividends are increasing gradually over time. You don't want a sudden spike in any one situation, but make sure that it continues to spit out dividends for you gradually over time. And if you do that, you are not going to be disappointed. I'd like to end by talking a little bit about something that Warren Buffett said a long, long time ago. When somebody asked him, he said, "Warren, if you are so smart, why don't more people follow what you do?" And Warren looked at the questioner and said, "Patience. People don't have patience. Everybody wants to get rich quick, but nobody likes to get rich slowly." But in the case of Warren Buffett, he gets rich slowly. And I think the takeaway really is that there are no get rich quick schemes in investing. You have to be patient. You have to build your portfolio. And if you do, then what you will end up with is a portfolio of good shares. And what I would like to do with my portfolios is that it will not only be able to sustain me, but I hope it will be able to be passed on to my son. And also, well, not my son only, but my children, my son and my daughter, to my children and to my children's children, and so that they will be able to enjoy what I started 2 years ago, many decades into the future. And that is where I would like to end by saying that you need, if you want to be a master of your portfolio, you need to know what to measure. And share price is often the wrong thing to measure. Instead, measure things that you can control rather than the things that you can't.
Thank you so much, David. I definitely want to be a master and not a slave, so I shall practice patience from now onwards. So up next, okay, we are pleased to actually have with us today Mr. Melvin Pan. He's the CEO, and Mr. J.R. Cheng, the CFO of Yoma Strategic. So I hand it over to them to do the corporate presentation today. Over to you, Mr. Pan and Mr. Cheng.
Thank you very much, Pauline. Hi, everyone. Thank you very much, David, for that very insightful presentation. And I guess I'm here to really talk about why Yoma could be one of your good companies in your portfolio. It's a pleasure to meet all of you. In the next 30 minutes, I'm going to go through a bit about Yoma, about Myanmar as a country, about the businesses that we are in, and also about a couple of more interesting things that we are doing currently. But for those of you who are not familiar with Yoma, we are a conglomerate in Myanmar. And as an investor, you will not be looking at Yoma unless you feel very comfortable and excited about the opportunities in Myanmar. For me, certainly, I feel very excited about the opportunity. I went back to the country 8 years ago, having spent 12 years as an investment banker. And the opportunity is truly astonishing. And for me, it's a once in a lifetime in terms of opening up of a very large country in a strategic location where many different businesses have huge potential to grow. Let me try to move these slides. So let me start by explaining a bit about Myanmar as a country. Now, Myanmar has been actually in the past one of the richest countries in Southeast Asia and one of the most well-organized and prominent. It was under the British Empire, British colony up until the 60s. And then since then, unfortunately, under military rule, the economy has steadily eroded. But we had a very good last few years where we had a peaceful transition into a civilian government, and that has encouraged investments and opening up of the economy. Now, fundamentally, Myanmar is exciting because of the geography and because of geopolitics, first and foremost. In terms of geography, if you look at the map that is presented in the slide here, you can see that we're surrounded by 5 key countries, but in particular, China and India being the 2 largest population country really can provide a lot of support and a huge customer base for Myanmar. In fact, 40% of the world population is right at our border. So geography is very good, but geography is also very good because we are the Western gateway for China to access the West. So if you look at from an importation perspective, oil and gas is piped through Myanmar into Western China. From the Bay of Bengal, there's a pipe that goes into China. And from a manufacturing perspective, China is very keen to manufacture in the Western China, in the poorer regions, and also send it across Myanmar into the West. So Myanmar has a strategic relationship with China as it has with the rest of Southeast Asia. From a geopolitical perspective, I think given the strategic location that Myanmar has, it enjoys a lot of support from many countries, including China. And much has been said about the Belt and Road Initiative, but there has been a lot of investments and a lot of discussions also on how China can further support Myanmar's economic development in the future. In fact, over the last few years, Myanmar has been one of the fastest growing countries in the world, having enjoyed an 8.5% GDP growth some 3-4 years ago. Even this year, where the world is contracting because of COVID, we are still expected to have positive growth of 1.8% and normalizing back to around 6% next year, as is expected. So the thesis for Myanmar is pretty simple, that we are coming from a very low base with a lot of support around nearby countries and around the world. Because of the low base, we are likely to enjoy multi-years, if not multi-decades of continual growth. And there will be a growing middle class and growing population that is exciting for the consumer businesses. And that's the reason why Yoma is solely in Myanmar. We have a very focused strategy in 4 key areas, 4 key businesses. We have real estate in Yoma Land, an Fmb business, a financial services business, and an automotive business. So we have a focused strategy focused on one country where we're looking to take a leadership position in each of these areas. And as the country grows, we would like to have a strong leading role in the development of those industries and make money from it, but also to build a better country for its people. Corporate governance is something that we care deeply about. We're one of the few companies that's listed from Myanmar in an international exchange. And beyond just being listed and having the halo effect of being on the SGX main board, we are also particularly focused on corporate governance. So we're very proud to have been selected as the best managed board, the Gold Award a few years ago. And we've consistently ranked in a high position in the corporate governance standards. So corporate governance is our key competitive advantage that we really leverage on the back of. Myanmar is a large country, and this graph shows a little bit about the scale of the country. From north to south, we go from the very cold area to very hot, but it's important to note that Yoma has presence across the country, which allows us to leverage off the growth throughout the country for the future. Over the last particularly 5 years, we have embarked on a huge diversification story. 5 years ago, we were largely a real estate company. 98% of our revenue comes from real estate, whether that's development or services. And then we made a decision at that time that within 5 years, we want to be a very much more diversified company. We want to have half our businesses to be in non-real estate businesses. And as a result, over the last 3-4 years, we've been incubating a number of new businesses and growing it substantially. As we select businesses, we look at multi-year, in fact, multi-decade opportunities that could be scalable, that will be large, that will have an opportunity to be a leading player so that we can have price leadership as well as thought leadership. And over the years, we would like to become a blue chip diversified conglomerate that leads in the country. And we're very proud to have been able to do that. The diversification, as you can see from the right pie, is much wider. We're not only focused on real estate anymore. We have a sizable Fmb business that is leveraged to the middle class. We have a consumer business also supporting automotive industries. And we're growing a financial services market that is actually very exciting, as we will talk about a bit more in the future. And that is really done through working with leading partners around the world. You can see on this chart, on this page, that we have many different partners. But the key theme across all these partners is that it is a leader, maybe the leader in each of its country or each of its industry. Our thesis is that in order for us to be the leading player in the relevant areas, we need to shortcut in terms of the expertise that we need to build. And it is best to build that by forming strong partnerships where we can leverage the experience overseas to build a leading business in Myanmar. So let me just spend 5 minutes talking about our core businesses in each of them before moving on to a couple of specific areas in fintech as well as our partnership with Ayala. Now, our largest business has been Yoma Land, which is a real estate business. We are the leading real estate developer, property developer, and a landlord. Having 9 million plus square feet of land bank, that allows us the opportunity to build 2 very large townships, as well as a city center project, which is a mixed-use complex called Yoma Central. You can see on the graph, on the picture that on the top, that we're building affordable residential products, basically apartments that are selling for as low as $50,000 US. That has proven to be very popular, and we think that that will plug the gap in terms of the need for urbanization in the country, in Yangon in particular. Yangon is our commercial capital with only 6 million people, which is around 12% of the population in country. We expect that to grow to around 10 million. And in order to house all these people with a young population, we expect a huge amount of needs for affordable residential properties. But in addition, we have a Yoma Central, which is the city center project. It's a mixed-use project. The picture on the bottom right that shows what it is. It's basically, we'll have a shopping mall, 2 office towers, a service apartment, and a hotel block, as well as a luxury hotel, which is co-owned by the Peninsula Group. We'll have the Peninsula Yangon there. That project will be completed over the next 18 months or so, and we expect to be generating significant recurring rental income for us. Moving on, in terms of financial services, Myanmar has an extremely underserved financial market. Banks are largely bypassed. The general public do not have access to either bank accounts or financing. And that gives us a couple of very interesting opportunities. One is on the leasing front. We're able to build a sizable vehicle leasing business where essentially we're borrowing from the international market at an attractive rate and lending in Myanmar at a mid-teens type of return on vehicles that we can rent out for the long term. And over the last few years, we've built up close to $50 million US of assets under management that generates a significant amount of recurring cash flow. We'll talk about our fintech business, but Wave Money has been a resounding success as well. Moving on to the Fmb business, on the right, you can see that we represent 4 key brands. We're the master franchisee for KFC, and we also have the leading noodle brand called YKKO in the country. That allows us to be the largest F&B operator, and we're now really the go-to group for any retail malls or any large location that's looking to open up a new site. Our view is, obviously people always need to eat, but bringing aspirational, good quality food is something that really can grow with the country over the next many years. In the middle, you can see that we have a bottling business. We have a joint venture with Pernod Ricard. Pernod Ricard is the second largest spirits and wine company in the world. We are producing local whiskey as well as starting to import other products. That we also expect to be a sizable business. Last but not least, we have a logistics and distribution business where we have a joint venture with SF Holdings, as well as a joint venture with the Metro Group from Germany. This is again leveraged towards helping on the logistics services in country and really becoming the pipe and the infrastructure for F&B and other logistics operations. Last but not least, we have an automotive business, which is a comprehensive suite of heavy equipment in agriculture and construction equipment, as well as vehicles. We have passenger vehicles and commercial vehicles. So we've selected a number of prominent brands like the Mitsubishi, Volkswagen, etc. And we are representing them on an exclusive basis in the country. Our view is, even though the market is relatively small right now, with not many people having vehicles, in these type of markets with these brands, is very likely that we will grow it substantially as the country opens up. And being the exclusive distributor, over time we'll be appointing also dealers to sell for us. The volume of vehicles and equipment that needs to be sold in country will be very large, and we look forward to capturing that market over time. So these are our core operations. We have a very specific strategy in all of these markets, but it's really building for the future to be a leading player. You will see that we are generally the exclusive country distributor for the prominent brands. We have built scalable business that allows us to really have certain price position. And we strongly believe that as the country builds itself and the GDP grows at mid to high single-digit rates over the next few years, there's huge operating leverage for us to earn a lot more profits as the scale increases. But within all of those, I think the fintech area has attracted much attention. So let me talk about that. There's a very strong fundamental for digital money in country. And the reason is because of the lack of banking penetration. Only 25% of the adults in the country have a bank account. And within that, those people with a bank account, very, very few people have access to credit, i.e. can borrow money from banks. The reason is because there are very few branches in Myanmar, and most people live more than 1 hour away from a bank branch and therefore don't have access to it. Now, in the last 5 years, Myanmar has seen an explosion in terms of technology advances. There's a true leapfrogging where we went from something like a 1% mobile penetration to 126% of mobile penetration, i.e. Most people have a phone. And interestingly, given the price drop of smartphones, most people actually own smartphones. So they have the internet at in the pocket. And most people now use Facebook and have full information on their phone. We're not seeing enough e-commerce right now, and partly because it's still quite new. But with COVID and with the coronavirus kind of prompting us all to live in a different way, we're also seeing an explosion in the use of e-money and the use of e-commerce. That is a very attractive and interesting trend that we want to drive on the back of. So, and partly on the back of that, but this is something that we've been working for a long time. We have announced a partnership with Ant Financials, the operator for Alipay in China. They will be investing $73.5 million for a substantial minority stake in Wave Money, our e-money business. The aim is really to substantially build Wave Money into a lifestyle platform that serves the mass population. and allow us to leverage Ant's expertise in mobile payment as well as the technology. Wave itself, before Ant came on board, has been a very successful business. In fact, we have an agent network that is second to none in the country, 58,000 agents throughout the country helping people transfer money. And in terms of financials, the profitability has increased substantially. This chart shows the contribution to Yoma's share of profit. Yoma previously owned 34% of Wave, and that a year ago, in the previous year, contributed around $0.2 million to us. In the most recent 12 months, it's contributed $6 million from this 34% stake. So 100% of the company will be generating more than $18 million. So you can see that the growth has been extremely high, and this is one of the few businesses that every single month we're able to see a double-digit growth in terms of our transaction volume as well as profitability. So overall, with the drive to improve fintech and technology and using Wave Money and leveraging Wave Money to partner with Ant Financials and building a bigger lifestyle app, what we're really planning and hoping to do is to make ourselves be the center of people's everyday life. What it means is that over time, we would like to be able to have people use the app on the phone to do a lot of services, from ordering KFCs to looking at real estate services to renting and leasing cars. All of that would generate a lot of data for us that would allow us to enhance people's experience. And what we're really trying to drive is to facilitate credit adoption in the country. In fact, unlike other markets where most people have a bank account and have some access to credit, in Myanmar, most people have very little access to credit. So they can't borrow money from the official markets, and they will have to borrow money from each other. What we hope to do is, by having better information on people and collecting better data, we will be able to facilitate financial inclusion and allow people to borrow at more official markets and more official rates. And that will be able to drive economics from the back of this information flow. So in addition to Ant's investment into Wave, we would also say we are also very glad to have agreed to buy out our partner's stake in Wave Money. Prior to Ant's investment, Telenor, the leading telecom company in Myanmar, owns 51% of Wave. We've agreed a transaction to buy over this 51% together with some of our partners. And as a result of that, we will be controlling Wave Money and having a majority stake. We really think that Wave Money and the digital wallet will transform the country. And by taking a leadership position, we will have substantial value creation on the back of this. So this is a very exciting opportunity, and we will update investors more as we have more progress. Let me end, and then I will move on to Q&A, end by just talking about our partnership with Ayala, which we announced at the end of last year. This is also a very exciting arrangement. For those of you who are not familiar with Ayala Corporation, they are the absolute blue chip company in the Philippines, and with multiple companies, each of multi-billion or 10 billion plus market cap. The interesting thing is, if you look at Ayala Group's business portfolio, they span real estate, financial services, telecom, utilities, many things that we currently do. In addition, if you look at the GDP per capita for the Philippines, GDP per capita for the Philippines some 15, 20 years ago is actually very similar to the GDP per capita in Myanmar right now. And if you look at Ayala's market cap in those days, it is also a fraction of what it is now. So the partnership has a very strategic value. What we are looking to do is to work together with Ayala to help us map out how we can grow our key businesses, particularly in real estate and financial services, so that we can be a leading player. they've agreed to inject 155 million US dollar for a 20% stake. We've done, I guess, 3/4 of it, and we'll be seeking shareholders' approval for the remaining 5% stake. Having done a sum of the parts analysis on Yoma's various businesses and have taken a discount on that, they are investing, they've agreed a price of 45 cents per share. Now, that is a substantial premium to today's share price of around 30 cents, 29 cents. And I'm very excited with the opportunity to work with Ayala. I think this, first of all, reflects their confidence in us, that they're investing is substantially higher than today's share price. But it also allows us a bit of a playbook and a strong partner to help us grow in the best possible way. Ayala's president and COO, Mr. Fernando Ayala, now sits on the board as a non-executive director. And there are a number of collaborations that we're already doing, for example, in the energy space. So I'm going to end the presentation here and open it up to questions. But I will just end by thanking all of you for joining. Myanmar is a country with a lot of potential. And for those of you who have not visited, I really urge you to come and visit. As you visit and you walk around the street, you will see that there is a lack of services across the board. But you also see that there's a huge potential. You know, people generally quite young, very hungry, very hardworking. This country is full of promises, and I'm very excited for the opportunity to be there to grow along with this country. Thank you.
Thank you very much, Melvin. So in our last segment, we have a Q&A session. We'll start the Q&A session with some of the pre-submitted questions, followed by addressing some of the other questions posted in this Facebook comments. So, and maybe due to time constraint, we would like to seek your kind understanding that not all the questions may be addressed. So without further ado, I'd like to invite also Benjamin Goh, our Head of Research from SIAS, to actually moderate this panel. Together with us on the panel will be Mr. Melvin Pant, CEO again from Yoma, and also Mr. Jia Ching, CFO. Over to you, gentlemen.
Thank you very much, Pauline. And also thank you to Mr. Poon and Mr. Cheng for joining us this evening. I can also tell you from a personal experience, a few years ago, I was actually on the buy side of the banking industry, and Yoma was one of the hottest stocks. Generally, you don't get many, Myanmar-based companies listed in Singapore. And of course, the good governance and the business strategy was very exciting for people like me. Okay. So thank you very much for joining us this evening. We have a couple of questions from our social media listening sources previously, and we are still waiting for potential questions coming from the Facebook comments. But I'll just kick off with the first question regarding Yoma's intention to take a controlling stake in Wave Money. And the question was, could management comment on the risk that Yoma fails to obtain regulatory approval to buy the 51% Wave Money stake from Telenor?
So we view that risk to be very low. Ongoing conversation with the regulators have been very supportive. They're very excited about both Ant Financials coming in to inject more expertise and capital to the business, but also Yoma as a kind of strong Myanmar-backed company taking over the controlling stake of this business. I think it's a really strong vote of confidence, but also allowing the business to be steered in a way that is long-term beneficial to the country. So I would say that it's, as with anything in Myanmar, you need a bit of patience in terms of administratively kind of going through it, but we should be fine.
Okay, that sounds very similar to the advice given by Mr. David Kwok just now about being patient. So I guess all good things come when you wait a little bit more, right? So that's good to hear. The next question we have is again regarding Wave Money. So the question was about the valuation doubling in 7 months between November 2019 when Yoma bought it for 10%, bought a 10% stake, I'm sorry, to June 2020 when Yoma intends to buy 51% stake. So I guess the question is, what contributed to the valuation and what are the factors driving that?
Yeah, do you want to take that?
Yeah, certainly. I think in answering the question, it actually is helpful to take a little bit of a longer term perspective and understand actually when Yoma acquired its initial 34% stake in 2018, how we went about thinking about the valuation for that business. If you think about Wave Money at that point in time, it was really at that inflection point where its business model was just about to start turning profitable. It was experiencing rapid amounts of growth. And it was a time when we felt that it was an attractive entry point for Yoma Strategic to come into Wave Money. We did an independent valuation at that point in time with PwC, and they came up with effectively a range where the midpoint was around $57 million, which is where we acquired our initial 34% stake at that point in time. If you roll it then forward to when we agreed to acquire the additional 10% stake in 2019, that was done at a very, very attractive level. And it was done because we were buying out the remaining 10% that was held by effectively our sister Myanmar company. So it was done at a very attractive valuation. It was pegged and benchmarked off of the 2018 numbers rather than any other sort of market comparables. And in the interim time period, as Melvin was mentioning, Wave Money experienced significant growth, both on the top line, but also it did hit that inflection point of becoming a profitable business and actually supercharging its profits, growing from 200,000 in the year ending 2019 to over 6 million in the 12 months ending 2020. So there was a very big, I guess, jump in financial performance that justified a much, much higher valuation for Wave Money as of today. The price that we're actually buying the 51% stake from Telenor is the same price that Ant is actually investing in the company in, as well. So there is a third-party validation for where we're buying that 51% stake from Telenor. It's the Ant valuation. Ant effectively did its analysis on two parts of the business. The first is in relation to the money payment transfer business, the domestic remittance over-the-counter payments side of the business. And that can effectively be looked at on a cash flow basis or effectively a multiple of EBITDA. And that's effectively how they valued that portion of the business. And then as Melvin was mentioning, there is a significant growth right now on the digital side of Wave Money, the growth in the e-wallet, the number of monthly active users who are coming into that ecosystem. And there you attach effectively a dollar price per MAU. And the way Ant looked at it, it was those two parts of the business. They attached a multiple of EBITDA, and then they attached a dollar price per MAU. And again, the value that we're buying, the valuation that we're buying our 51% stake from Telenor is the same valuation that Ant is investing in the company in as well.
Okay, thank you very much for that. I guess to summarize, the initial value or rather initial investment was a little bit on the lower side simply because the terms and conditions are a little bit different and the business has grown over the years, right? And right now, the amount of money, the amount of investments that Yoma is going to be pumping in is, in your view, fairly valued given the performance that the company or Wave Money has shown over the last few months, right? That's about right. So the base was a bit low and currently is fairly priced. So that's why, the price tag's a bit higher.
That's correct.
Okay.
And of course, the growth prospects, as with Ant coming in to help add its expertise and capital to supercharge the growth of that business going forward.
Yes, no, I totally agree. I mean, a lot of us normally we look at price and we forget about value, right? So, you get what you pay for. So obviously the company is doing well and the price has to go up. So I think that's, there's nothing strange about that. That's very normal, actually. Okay, the next question that I have is, so we had a slide from the presentation from Mr. Poon just now, and transaction growth from Yoma, it's incredibly impressive, obviously. And the question is, given the current COVID-19 pandemic, what kind of impact do we expect to see on Yoma's business as well as its financial bottom line?
Right. So our biggest business still is real estate, and so a lot of our revenue continues to be in the real estate area, and certainly a lot of profits come from real estate. In that business, we are quite fortunate that any impact from COVID will not be felt for another 18 months at least, I think. And the reason for that is the largest project in terms of revenue contribution right now is a project we call City Loft, which is the affordable housing, that picture that we showed. That has been, all the units that we're building have all been pre-sold. So it's locked in, we know who the customers are, and the revenue recognition will come from the progress of construction. So we just need to construct, and then the revenue will come. In fact, we have more than 20 million of revenue that is unrecognized and just needs to be recognized after we construct. So over the next, I would say 12 to 18 months, the real estate revenue from that project will continue to be recognized. In fact, with COVID, our projects generally are in gated communities where we have our own security, we have our own landscaping, maintenance, etc. And it's proven to be a bit of an oasis for residential people looking for a safe place to live. And the interest for people to move in either for rental or for purchase have increased substantially in the last few months. So I think real estate is actually going to do quite well. And all eyes are really on the Yoma Central project, where it's still 18 months away from completion. But once that is done, our recurring revenue substantially increases, and that will put the company into a totally different position. Now, there's one area that is particularly impacted by COVID, which is our consumer business. Fmb, etc. The dine-in have been restricted. We're quite lucky that the food delivery companies, all the international big ones, Food Panda, etc., all came into Myanmar over the last 6 to 9 months, and they're in heavy investment mode. And we've been able to enter into a couple of very strong partnerships. So the growth from food delivery has been explosive. But still, overall revenue impact for F&B will be down, and it's still expected to be down for the next few months. I think we already mentioned that financial services, with the digitization and the drive of e-money, is actually been very positive. It was quite interesting that the government did an economic relief plan specifically targeting COVID, and they put e-wallet. In fact, they put Wave specifically. They named Wave specifically as one that they want to encourage. So they are now distributing agriculture grants and subsidy loans through Wave, and I think that you will see a lot more promotion. So I would say that overall, the next 12 months overall revenue will be substantially higher than the last 12 months revenue, even with the COVID impact put in.
I think that's very heartening for investors as well, listeners, to kind of know that. And it's kind of fortunate that the business as structured right now is sounds pretty immune to what's happening in the rest of the world. So that's all good news. We have another question here about diversification. So internally in Myanmar, Yoma has diversified across many different business lines, right, into fintech, F&B, so on and so forth. So the question here is, does Yoma have any plans to diversify out of Myanmar? And I guess, specifically on the fintech side, because that's obviously highly scalable, so on and so forth. So what are Yoma's plans with regards to that?
So we do not plan to diversify outside of Myanmar. Our view is we have a strong competitive advantage in Myanmar, and there's just so much growth. If anything, I think we've expanded and diversified into too many areas within Myanmar. And over the last couple of years, JR and myself have been working very hard to streamline our businesses so that we can be focused on the core areas that matter. So we've sold off our towers business, telecom towers business, and we've sold off a couple of other things. But those selling off have been very positive. If you look at our towers business, we made 4 to 5 times our money, which has been very substantial. But we don't see much benefit in us expanding to other countries and just fighting it out with the big guys. We might as well be in Myanmar and grow with the country for the next decade. Okay,
that makes sense. So related to that question just now, and you alluded to that that Yoma has, a lot of business lines and maybe too many. So this question is, with so many good partners working with Yoma, what is Yoma going to look like 5 years down the road?
Yeah. We manage each business very carefully. So each of the silo, we want to make sure that they individually becomes very strong. So we've stated that each business should be able to be a standalone business that generates significant amount of profitability. at the end of the day, it really comes down to profitability over time, right? Just like the previous speaker talking about dividend and profit, I looked at cash flow and profits. I would certainly hope that in maybe, I don't know whether it's 5 years or shorter or longer, but some of our businesses should be able to stand alone, be profitable enough to justify something more like $1 billion market cap, which is bigger than Yoma is today. And hopefully we can actually split them out so that investors can be investing in a specific business area, let's say real estate or fintech. But outside of corporate restructuring, I think the roadmap 5 years from now is to be a clear market leader in each of these areas and having clear amount of profitability so that we can pay dividends to our shareholders.
Okay, all right. Sorry, I've got a couple more questions coming in. So another question that we just got through the comments is, okay, you had a slide in your PowerPoint deck that showed Yoma's average share price of 31 cents compared to a book value of 38.9 cents, which suggests that the current share price is trading at a discount, right? So, usually one of the reasons for a discount is perceived risk in investing in the company. Perhaps you could discuss some of the risk factors that Yoma is facing, and also specifically the risk of default, since you have got quite a big presence in the fintech business, with or via Wave Money.
Yeah. So the good thing about our fintech business right now is we're not actually extending any loans. So we're not subject to default risk. We make all our money from money transfer. So person A sends money to person B. We charge somewhere between 1.5% to 2% of commission, and it's full of these 1.5% to 2% commissions throughout the day that we make money from. We processed 6% of the GDP last year, and that's probably going to be more like 10% this year. So that is a core business that will continue to generate a lot of cash flow for us without any credit risk. But I do get your point that we are trading at a substantial discount to book. And in fact, what is not kind of widely talked about is our book value also substantially understates our true value. I think you can see from the fact that Ayala is investing a lot higher than book value, but also we've done a couple of partnerships. For example, this Wave Money transaction, and Financials, the most prominent fintech company in the world, is valuing it at 3 times what we have on our book value. We have a leasing business where we brought in a prominent Japanese leasing finance company, and they valued it at more than 5 times our book value as well. So I think there are various businesses that book value just doesn't reflect the true value. Why we've invested money into KFC, for example, and the book value is just how much we put in. But obviously now that we have a substantial presence, the business cannot be just worth book value. But I think the reason why we're trading at a discount to book value and a discount to what I believe is true value is partly because the point about patience. Myanmar is a country that requires a bit of patience. We had a lot of bad press around the Rohingya issue, around maybe perceived slower economic development than expected. I personally feel that there's been a huge amount of progress in the last 5 years, but obviously it's not been enough compared to what other people have been expecting. And I have a longer term horizon in the growth of the country. But if you're looking for a quick buck over the next 3 months, what is the catalyst? That would be the question. We think that it's hard to focus too much on short-term share price, but if we focus on cash flow and profitability, and in a couple of years' time, Yoma Central comes through fintech business becomes even more prominent, I think the cash flow will speak for itself, and then we will be much better in terms of reflecting our true value.
Okay. Yeah, so sounds like the theme of being patient is kind of the main idea. And, I hear what you're saying. So obviously Myanmar is a emerging market, and we do have to be patient, for things to progress. The next question that I have is regarding the revenue compositions of your real estate, your fintech, and consumer business lines. So how do you see this revenue composition between all your business lines changing over the next 3 to 5 years?
I'll send the difficult questions to JR.
Yeah, definitely. If you roll this story forward across all the various businesses, we would still say real estate is going to be our largest and most prominent business within the group. Basically, if you look at the top line contributions, it would probably be anywhere between 40% plus of the top line contribution for the group still coming from the real estate business, both the services as well as the development side of things. If you take the financial services business, again, that's the fastest growing. As you saw from the pie charts earlier, it's actually a relatively small contributor to Yoma's top line as of today. But as that grows and grows quite quickly over the next couple of years, we'd probably say that's probably going to end up anywhere between 30 to 40% of your top line contribution. Then you have F&B, and then you have automotive as being the balance. So let's call F&B anywhere between 15 to 20%, and automotive, call it around 10 to 15% of contribution.
Okay, and I suppose it's going to be a very happy coincidence if the fintech business grows to be so large that you need to split it off and like Grab and all that, and I guess that will make everybody happy, especially the investors in Singapore, right?
Yeah, well, we hope to do that. I mean, someone has been quoting and hoping that Wave will be the first tech unicorn in Myanmar. I mean, certainly if we look at the pace of what we're growing, we'd like to get to a monthly active user rate of more than 11 million people within 4 years. If you look at any matrix of the valuation per monthly active user, we should be at somewhere between, very close to those kind of unicorn levels. So yeah, I think the Ant transaction provide us the technology, but also the money to fund us all the way to that aspiration. So we don't have to worry about funding, and we just need to execute. I think the key theme for Yoma is really about how to execute in a more precise and focused way to get to the where we want to be in 2 to 4 years' time.
Yep. Okay. I guess it's already 2 minutes past 8. Maybe I'll just, we have got a couple more questions. Maybe I'll just pick one, a little bit more interesting one. Okay, I'm not sure whether you could answer this, or maybe Mr. Ching could, since he handles the more difficult questions. How do you see the bottom line for this current financial year, as well as the next 3 years for Yoma?
Yeah. I think, as Melvin said, we do expect actually to come out of this COVID period in a relatively strong position, especially on the top line. So I think we can very confidently say that our top line will be higher than we were in the last 12 months. So for the period ending March 2020, the bottom line, I think, is gonna in a sense follow that top line growth in terms of turning the corner from where we were last year and the last 12 months. So I think in terms of giving guidance and giving profitability, let's call it forecasts, that's not something we prepare to do every conference call. But I think we will be in a better position, and a much better position than where we were last year. I think just to note the numbers that we reported in the March 2020 disclosure period, in some ways were not comparable to the previous year. They weren't like for like, because we've changed our accounting year end to being in September, and we conduct a number of annual exercises only once a year. So that'll actually come through in our September numbers when we report them in about 3 months' time. And then as we roll it forward for the next 3 years, I think, as Melvin was mentioning, there's a big focus on execution, a big focus around operational profitability in each of the various business units. And so I think that's going to be definitely an area that you're going to see continuous improvements. One thing to note that was tangentially raised by Melvin is we did start a number of businesses over the last 4 or 5 years. Clearly, those businesses need a period of incubation. They need a period of runway to be able to get to the levels where they're going to have the scale and the size to become profit contributors. And we're actually at that inflection and tipping point now for a number of those non-real estate businesses. So whether it's food and beverage, whether it's automotive, or even whether it was Wave Money. Wave Money hit it very, very early. But whether it's those other businesses that have been incubated over the past 4 or 5 years, we should be hitting that inflection point in the coming, let's call it 12 to 18 months, where they start becoming significant contributors to the bottom line as well.
Okay, 12 to 18 months, that's a relatively short time, even for, relatively impatient Singaporeans. And I think that's all the time that we have therefore, so we can call it a wrap. Thank you very much to Mr. Pan and Mr. Cheng for the Q&A session. I think it added a lot more color to the deck, and I think our retail investors will be a lot more knowledgeable about Yoma's businesses as well as its financials going forward. So over to you, Pauline.
Thank you very much. Thanks, Benjamin. And thank you again, Mr. Pan and Mr. Cheng, for joining us the session today. So we've come to the end of today's session, and it has been really a pleasure to have so many of you, over 140 of you today with us on Facebook Live. So for those who have just joined us in this session, our video will actually be on SIAS Facebook page, so you can actually come back again to watch the video again. And so do like our page again and check out our website to get more updates on our upcoming investor education programs and initiatives. So once again, thank you all. Thank you, Yoma, for taking the time to do a presentation tonight, and have a good evening, everyone. Bye.
Thank you. Bye-bye.
Thank you.
Thank you.
Bye.